Ind AS 12 income taxes. Current tax expense is payable as per Income Tax Act. Deferred tax expense means temporary saving or payment due to difference in carrying amount and tax base of assets or liabilities. Current tax. Journal entry current tax expense P&L account to provision for current tax liability which is in balance sheet. Deferred tax calculated based on temporary difference between carrying amount and tax base of assets and liabilities. Carrying amount is as per books of accounts, tax base is as per Income Tax Act. This is a little trick to identify DTA DTL. Take asset as base. When asset goes down, asset decreases, opposite DTA. Asset increases, opposite DTL. And same for liability. For liability it is in same direction. Liability increases, DTA. Liability decreases, DTL. Tax base is the base for computing increase or decrease in assets or liability while comparing with carrying amount. Note: interest income will be recognized in income tax on date of actual receipt only. Tax base is equal to 0. Fair value gain or loss on investment is not recorded in income tax. Tax base is equal to value on date of investment. Income received in advance is taxed on receipt date. Tax base is equal to 0. Transaction cost allowed as deduction on payment date. Calculation of DTA DTL. DTA DTL is equal to temporary difference into tax base. Tax rate. Temporary difference into tax rate. This is the closing balance of DTA DTL. This is the closing balance and which is reduced by opening balance of DTA DTL, which gives DTA DTL recognized in either P&L or OCI in current year. If deferred tax expense created due to fair value changes, then impact is given in OCI. Tax rate used is equal to substantially enacted tax rate. Tax rate announced before balance sheet date. Journal entry for DTA account data to deferred tax expense account. Deferred tax liability is equal to deferred tax expense to deferred tax liability account, DTL account. Other points: investment in subsidiary, associate, joint venture asset, carrying amount is equal to investment amount plus or minus share in profit. Tax base is equal to investment amount. If parent entity is able to control timing of reversal, no DTA DTL on investment in subsidiary. Leased asset. Next, carrying amount, closing balance of ROE asset on balance sheet date minus closing balance of lease liability on balance sheet date. Tax base is equal to nil. Allowed as deduction only on payment basis. Next, Ind AS 2 SBP transaction, always DTA. Carrying amount nil. Tax base is equal to employee benefit expense recognized till date of intrinsic value of option. Next, DTA DTL on any expense not deducted or allowed as per Income Tax Act. Tax base is equal to carrying amount. Next, carry forward loss. Technically an asset, which means technically an asset going down, which means the opposite. That means DTA is created. This is just a trick to remember, not any other explanation. MAT credit is equal to DTA. Assets or liability acquired in business combination, the net assets. Carrying amount is equal to fair value of the net assets. If it is more than tax base, then it is DTL. Less than tax base, it is DTA. DTA DTL recognized through goodwill or capital reserve. Tax rate is equal to rate applicable for acquiring entity. If no tax base in question, then carrying amount is equal to tax base. Recognizing DTA only if probable that there would be sufficient taxable profits in future. Reconciliation between tax expense and tax on PBT as per books. Tax on PBT plus tax on items not allowed in Income Tax Act gives current tax and deferred tax expense. Next, tax rate reconciliation. Applicable tax rate plus tax on items not allowed or deductible in Income Tax Act divided by PBT as per books into 100, which gives average effective tax rate, which is tax expense divided by PBT as per books. Next, to offset both tax asset and tax liability are to be levied by same tax authority. This is end of income tax Ind AS 12.